Permanent life insurance is sold incorrectly by almost 90% of life insurance agents. That's prompted many in the financial industry, like Dave Ramsey, to say that permanent life insurance is never appropriate. But then we hear people like Alex Hormozi say that he actually uses permanent life insurance personally, but warns that if structured improperly, you will get ripped off. Let's hear what they actually have to say about permanent life insurance. We'll start with Dave Ramsey.
Whole life insurance, cash value life insurance is the payday lender of the middle class. I've been screwing the middle class for decades.
Now let's hear what Alex Hormozi has to say about how he uses permanent life insurance.
This is what I have invested my money in this year. First, we have a whole life insurance policy, high cash value upfront. You have to be really careful about the people that you work with this because they can totally screw you and they are incentivized to screw you. And most insurance agents will not want to hear that. But the commission structure that they have for these policies is insane. It destroys the cash value that you earn from these things. So
in this video, I will break down some of the common sales concepts about permanent life insurance, where it's appropriate and where it's suitable, but also where it's oversold. First of all, let's look at some stats around permanent life insurance. According to a LIMRA study in 2022, permanent life insurance in the US made up 70% of all life insurance sales. That's wild. The reason why it's wild is because 70% of people absolutely do not need permanent life insurance. I would say generally, permanent life insurance is suitable for about 10% of the population and appropriate for maybe 3%. You notice I differentiated between suitable and appropriate. Suitable means that in an array of tools, permanent life insurance could be an option. But appropriate means that it's probably the best option. Next, let's look at policy cancellation rates. This is particularly a useful stat. However, it's really difficult to get data on this because insurers don't want this published. I did find a study from 2005 that looks at cancellation and lapse rates on whole life policies in their first 5 years. As you can see, the highest cancellation rates are generally in years 1 to 5, which unfortunately means that people lost money purchasing as cash value takes a while to accrue in permanent policies. Lapse rates drop dramatically in years 4 and 5, and less than 5% of permanent policies are canceled after year 5. This chart also marks a stark contrast between small whole life insurance policies that are sold, which is like $50,000 and under, and larger whole life insurance policies which are sold, which are over $50,000 in face value or the insurance coverage itself. My theory on this is that the reason why the smaller policies are canceled so highly is simply because they are sold to unsuitable candidates. So people who are potentially having debt, people who are potentially having low cash flow. And basically what happens is they're sold on it that's a good idea, but then cash flow constraints require them to cancel the policy, or they get a second opinion from someone who tells them it was an unsuitable product for them to purchase, and they cancel it within the first 3 years. Generally, my theory on the larger policies having lower lapse rates is simply because they're probably sold to wealthier individuals who don't see those dramatic spikes in cash flow, and generally they're maybe a little bit more suitable for those individuals than the lower earning individuals who are sold en masse by big insurance companies. Now let's look at and refute some of the strategies that are used to sell permanent life insurance policies to Canadians. The first one is infinite banking. This is sold by almost all small volume agents and has a pretty catchy sales pitch. First off, you purchase a whole life insurance policy. Then you borrow back against the cash value to basically fund your lifestyle needs. The way that they structure this is such that the cash value is earning between 4 and 6%, better than what a bank account will give you, and then you borrow back against those policies to fund your lifestyle. There's a few problems with this though, and I'm going to address each of them. Number one, it encourages you to use borrowed funds to spend on material needs. This is a little bit mind-boggling. That's never how people get wealthy. People get wealthy by saving, accumulating, taking risks, starting a business. Number two is that interest rates right now are much higher than the 4 to 6% that the cash value will be accruing within the policy. You're potentially borrowing back over 7%, meaning you're losing money by paying non-deductible interest in Canada on the loan portion. Meanwhile, the cash value is only growing at 4 to 6% within the policy. Another problem is that the policy itself is often sold by insurance agents using a bait and switch method. They'll sell the concept of infinite banking, but then what they'll do is they'll structure the policy to maximize the life insurance component, which pays them the most commission. Another problem with this is that the cash value tends not to accrue very much in the early years, at least not at the same rate that you contribute into it. For example, if you pay $1,000 a month into a permanent life insurance policy, you will not have $1,000 of cash value. And if canceled due to cash flow constraints, that will cause the purchaser to lose money. And we do see that they are canceled on an annual basis at almost 15% for the lower face value policies. That means that a lot of people are losing money on this and the insurance companies are making money. There's also way too high of a commission incentive for agents to sell this to people who are not suitable for this product. So you likely aren't getting unbiased advice. For example, if you put $1,000 a month into a whole life insurance policy, the agent's commission might be upwards of $10,000 to $15,000 in that first year. Versus if you were to put that into a TFSA or an RRSP, even if that financial advisor managed those funds for you, they're at most making 1% per year of the balance of your investments. So if you put $12,000 a year into a TFSA, they're making $120. Let's move on to the next one, which is the claim that I don't want to pay for something that I get no return on in the end. This is why I want to purchase whole life insurance. Agents who promote this and validate this from a client perspective are being dishonest about what insurance actually is. In simple terms, insurance is simply a way for you to transfer the risk of devastating financial loss to a third party. You pay for that risk transfer through something called the NCPI, or the net cost of pure insurance. This is just what insurance costs, no bells and whistles added. Term insurance is this risk transfer. So it is the transfer of you financially being devastated, or your family financially being devastated by your untimely death. And because it would cost you potentially $1 million to pay off a mortgage, cancel student loans, provide income for your family in respect to what you're earning, then it makes sense to transfer that risk to a third party, at least when you know that's going to be the most financially devastating. And then over time, once you've built your net worth, that risk gets lower and lower of financial devastation, and you can decide whether or not you want to continue paying for that transfer of risk. It's important to note that anything you pay above the NCPI, or the net cost of pure insurance, makes the policy you are purchasing no longer just insurance. And then you have to compare it against the suitable alternatives, like a TFSA or an RRSP, or a simple index fund portfolio that you can buy in a taxable account. Now let's look at some real reasons where permanent insurance may actually be suitable and appropriate for people. Let's say you're a business owner and you have a corporation. Your corporation is set up and it's earning quite a lot of money. You are paying yourself a healthy salary, maximizing your RSPs and tax-free savings accounts. As well, you still have money left over in the business that you don't need for continuing business operations, so you've decided to invest that money in your corporation. Now, let's also assume you have an insurance need, either a mortgage, maybe buy-sell insurance if you have a partner, key man insurance, something like that, or you have high taxes owed at death and you want to structure it so that the money gets to your beneficiaries in a very tax-efficient way. If the business owner is wealthy and is accumulating retained earnings in their corporation that they're using to invest in investment products, mutual funds, index funds, or something like that, this could affect a few things within their corporation. Number one is the more investment income generated from a corporate portfolio, the more the small business tax rate gets reduced on real business income. So if you are under $500,000 in earnings and you have $50,000 coming in investment income through the form of dividends or interest or capital gains, you will actually start to get taxed more highly on your active business income. The distributions, like dividends and interest and capital gains from a corporate portfolio, are taxable in the year that it's earned. And that can be up to 50%. Some of that is refundable in certain situations, but that means that a business owner is essentially getting between 38 to 50% of their investment returns gone to tax. Another area to consider here is if you, the business owner, are seeking a way to get funds out of your corporation the most tax efficient way possible. And in this situation, you have a medium risk tolerance and have invested your corporate portfolio in about 75% stocks and 25% bonds through either individual holdings or mutual funds or index funds. In this case, what we have done in the past is we've structured whole life policies so that the amount allocated to bonds, which produce interest income, which is very highly taxable, and a lower investment return than the stocks will likely get you, we have structured in some cases that portion of the portfolio goes into a permanent life insurance policy. This does a few things. Number one, it shelters the growth of the policy. So if you do get the 4 to 6% returns that historically permanent life insurance has provided, then that will not be taxable to the corporation. So you're preserving your returns inside the whole life insurance policy. It will still trail a portfolio of stocks in terms of the net after-tax returns likely over a 10 or 20 year period, but it will likely produce very similar results to a bond portfolio and a better after-tax result. Next, when the business owner dies, they can pay out a mostly tax-free dividend to their beneficiaries of their estate. This is done because the life insurance proceeds credit something called the capital dividend account, which is eligible to be withdrawn to the estate in a tax-free manner. This is suitable, but not always the best option, because what is often overlooked is the need for insurance in the first place. If the need isn't there, permanent insurance is likely not suitable or appropriate for that business owner. There are some other needs that permanent insurance can cover, such as an investor who decides to invest heavily into real estate and wants to preserve those properties for their next generation. But if they be a huge tax bill causing them to sell some of the properties. In that case, permanent insurance can be suitable. It can either be structured as a term to 100 policy, meaning you have the policy until age 100, but there's no cash value, or whole life insurance can be suitable in this scenario if the business owner wants to borrow back the cash value of the life insurance policy to invest in other properties. But it's important to note that if these policies are not structured correctly, then you will lose money on them. And the way that they are normally structured correctly is higher cash values up front, allowing the policy owner to borrow back against the policies if there is unexpected cash flow events or the need to use some of that capital for investment opportunities. So here's a few rules of thumb for those seeking permanent life insurance. Number one, use a reputable company. Using a reputable insurance company, like one of the bigger companies in Canada that have been around for 100 years plus, like Canada Life or Manulife, these companies have reputable track records of being responsible with the cash value invested, as well as over 100 years persistency in the insurance industry. The second one is get advice from someone who has more than just insurance in their tool belt. Often these policies are oversold by people who only possess a life insurance license, meaning they view their solution to every financial problem as life insurance. But in reality, often there are many solutions that can come into play. So make sure you get advice from someone who can do more than just sell permanent life insurance. I hope this video was helpful. If you like this content, please click like and subscribe for more financial content for Canadians.